The stock market loves talking about new tech, explosive growth. But sometimes the real drama, the really interesting stories, happen when a huge, iconic brand just hits a wall. And today we're talking about Campbell's. I mean, this is a foundational American company. A brand so famous it was immortalized in, 32 Andy Warhol pieces? And right now, ticker CPB is serving up some serious disappointment. After its first quarter of fiscal 2026 earnings came out, the stock just sold off sharply. But here's the number that really it floors me. Campbell's shares are down 32% year-to-date. 32%. That puts the stock at its lowest point since the 2008 financial crisis. So that's the paradox we want to dive into for you. How can this essential comfort food brand, the definition of a staple, be struggling so much? And at the same time, why is it suddenly showing up on every value investor's wish list for 2026? Okay, let's pack this.
That's the mission, right? We're connecting the dots between this brutal market reaction, the industry headwinds that are just crushing consumer staples right now, and then the specific moves Campbell's is trying to make to navigate all of it. And for you, if you're focused on income, the payoff here is pretty immediate. That massive stock drop has pushed Campbell's dividend yield to about 5.5%.
5.5%.
Yeah. And when you compare that to the S&P 500, which is yielding, 1.1%?
Barely, yeah.
You're looking at 5 times the income potential. So the big question is this a real opportunity or is it a classic value trap?
Right. Let's start with the source of that fear.
Yeah.
Because a 32% drop says the market is terrified. We should probably lay out the hard numbers from Q1 that really triggered this latest sell-off. The results were, there's no other way to put it, they were just poor. Campbell's reported a 3% drop in net sales. And even more concerning, their adjusted earnings per share, their EPS, it plunged by 13%.
That's a significant decline for a company that's supposed to be slow and steady.
Exactly.
And the real weight, I think, came from their outlook, their guidance.
Yeah.
Management basically told the market that the pain isn't over yet. They're expecting flat organic sales for the whole year and an adjusted EPS decline of somewhere between 12% and 18%.
Wow.
So that midpoint, between $2.40 and $2.55, that's what sent the signal.
I think the key thing we need to figure out for you is whether this is purely a Campbell's problem, bad execution, or if it's an industry problem. Because that 32% drop, it feels like the market is pricing in a company-specific disaster.
It does. But the sources we're looking at, they point to something much bigger. This is a classic macroeconomic squeeze. It's hitting the entire consumer staples sector.
Which is the worst performing sector this year, right?
The single worst, yeah. This is a massive tide that's just pulling all the ships down, and Campbell's isn't big enough to fight it. Look, here are the pressure points. Inflation is driving up all of their costs, everything from logistics and packaging to tomatoes and wheat. But at the same time, consumers are feeling that same squeeze, so they're pulling back. They're looking for value.
So they're caught. They need to raise prices to cover their costs, but if they do, they risk losing shoppers to, cheaper store brands.
Exactly. And it looks like they're choosing to absorb a lot of those costs, probably to protect their market share in things like soup and V8, which is smart for the long run, but it absolutely crushes their short-term profits.
And that's what the market is seeing. That 32% drop is pricing in these margin issues as if they're permanent.
Right. It's pricing in years of stagnation. That's why it looks so cheap, but it's also why everyone's so anxious.
Okay, let's shift gears then. Let's look at what management can actually control. Because we have to remember, Campbell's is so much more than just condensed soup these days.
A lot more. And that diversification really started in a big way with the 2018 acquisition of Snyder's-Lance. Now, you can argue, and a lot of analysts do, that they overpaid for it.
A common critique, yeah.
For sure. But that deal brought in a huge snacking portfolio. We're talking pretzels, chips, popcorn, cookies. It gives them a foothold completely outside the soup aisle.
And now management has laid out these 4 pillars for their strategy. They are premiumization, flavor exploration, health and wellness, and cooking and comfort. Now, when I look at that list, one of them really jumps out as, counterintuitive right now, premiumization. If consumers are trading down and looking for value, why on earth are they focused on making things more premium?
That is a really sharp question, and it gets to the tension of managing a portfolio like this in an inflationary time. Premiumization here isn't about ignoring the budget shopper. It's about capturing someone who's making a different kind of trade-off.
What do you mean?
Well, think about it like this. Someone decides not to spend $20 on a meal at a restaurant. They're cutting back. If Campbell's can offer them a really high-quality, convenient meal at home for, say, $5 or $6, they win that spending.
So they're competing with restaurants, not just with the generic store brand of soup.
That's the idea. They're focused on making those at-home experiences worth it. Better flavors, better quality.
So that's why cooking in comfort is such a big pillar for them. That trend is actually working in their favor.
Exactly. That shift from people eating out to cooking more at home, that is probably the single most bullish long-term trend for Campbell's. It directly supports their core meals and beverages business.
Okay.
The problem child, or the more challenging segment, is snacks.
Mm.
That's more discretionary. The CEO, Mick Becusin, he said that people are still snacking, but how they're snacking is evolving. They want healthier options. They want experiences that feel worth it.
Which puts a lot of pressure on some of those legacy Snyder's Lance brands.
Mm.
They have to fight that perception of just being a, unhealthy packaged food, especially when competitors like PepsiCo are pushing mini meals.
And that's where the health and wellness pillar comes in. They're leaning into it with brands like V8 and all the low sodium or heart-healthy soup options. They have to make those investments to capture that consumer, even if it hurts margins in the short term.
Okay, so this is where it gets really interesting for me. We're moving from all the pain points to what could be a historic opportunity. Despite the bad results and the weak guidance, our sources are positioning this stock as an exceptional buy for two specific types of investors: the deep value hunters, or maybe more importantly, the passive income hunters. Let's start with that income stream, that 5.5% yield. The annual dividend is $1.56 per year. And if we use the midpoint of their own guidance for this fiscal year, the payout ratio is 63%.
And we should probably explain that payout ratio. It just means that for every dollar of profit they expect to earn, 63 cents is going out as a dividend. On paper, that's a pretty safe number. It leaves a good cushion for everything else.
Okay, 63% sounds safe, but they're also forecasting an EPS decline of up to 18%.
Yeah.
So what's the real risk here? What if they miss even that low guidance? Is that 5.5% dividend actually safe?
That's the right question to ask. And look, even if they hit the absolute bottom of their guidance range, there's still a margin of safety there. But beyond the math, you have to think about the institutional incentive. They aren't a dividend king like Coke or Pepsi, but they do have a 20-plus year streak of maintaining or raising the dividend since they cut it way back in 2001.
So it's a matter of trust.
Exactly. Cutting it now, after the stock has already been punished this badly, would be a catastrophic signal to the market. I think that dividend is safe.
All right, now for the other part of the equation, the deep value proposition. This is where you can really see the market's overreaction in the numbers. The stock is trading around $28.47 a share. That gives it a price-to-earnings ratio, a PE, of just 11.5 times their projected earnings.
An 11.5 PE for a blue-chip company like this is, it's historically absurd. A stable consumer staples company usually trades somewhere between 18 and 22 times earnings. To give you some context, Campbell's own 10-year median PE is 21.1.
So the market is valuing it at basically half its historical average. What kind of assumption is baked into a number that low? What is the market saying at 11.5 times earnings?
It's pricing in what's called terminal decline.
Meaning it's just going to shrink forever.
Right. It assumes that today's low earnings are the new normal, or that margins will just keep falling indefinitely. For a company selling things people need, the backbone of the pantry, that is just an extreme emotional assumption based on short-term fear.
And that's where the opportunity comes from.
That's the whole thesis, the opportunity for what's called multiple expansion. If they just navigate this period and margins start to get a little better, if that PE multiple just gets back to, say, 15 or 16.
Which is still way below its average.
Way below. But you're looking at substantial stock appreciation just from the market deciding it's not dying after all. That huge gap between 11.5 and 21.1, that's your margin of safety.
So let's bring it all together for you. We have this massive dichotomy. On one side, you've got poor results, weak guidance, all driven by these huge industry pressures. But underneath all that, you find a reliable, high-yield dividend and a valuation that is just historically cheap.
And a management team that seems to be making the right strategic pivots.
Right. And the key advantage they have over, say, a pure snack food company is that meals and beverages segment. It's the anchor that lets them capitalize on people cooking more at home, which the valuation seems to be completely ignoring.
So if you're an investor prioritizing income or just looking for some stability in a volatile market, that depressed valuation offers a pretty big cushion. The market has, I think, already priced in the worst-case scenario.
So the bar is set very low.
Incredibly low. And here's a final thought for you to chew on. Since Campbell's has already guided for such a weak year, market expectations are on the floor. So think about this. Given that rock bottom 11.5 PE multiple, how much would the stock jump if they just manage a small beat? A tiny surprise to the upside next year. The potential for a huge return based on just mediocre success is immense, simply because the market has already given up.
Fascinating paradox. Great analysis of CPB. Thanks for sharing your sources and taking this deep dive with us. We'll see you next time.